All right, guys, today I am here with Tyler Hamelwright of Mesquite Tax. He is a CPA. He's been in the business for about 15 years, so he knows what he's talking about. And today he's going to give us about 7 tax-saving tips that everybody can implement. So, Tyler, thanks for being with us. What is tip number 1?
Yeah, thanks, Mike. The first thing is make sure that your tax withholding is appropriate. If you are a married person, you got 3 kids, your wife doesn't work, if you're withholding that single, you're going to end up getting a massive refund, but you just left all that money with the government for a whole year. So go into your personal tax situation, make sure that you withhold properly.
And is that something that you can adjust anytime?
You can adjust at any time, and there's times where people actually get a big bonus as a wage earner. And what you can do is you can go to a higher withholding rate for that specific bonus because they're going to withhold a lot of taxes because they think you're making a whole bunch more money than you really do.
Okay.
So it's something to look at, and you can adjust it even every month. You just got to talk to your HR department. Another tip, find a retirement plan that works for you, and it depends on how much do you want to save each year.
Okay.
If you are involved in a 401k at your work, it can go up to $19,500, and anytime I say catch up in this, that means you're 50 and older. So
Okay.
there's a $5,500 catch up. If you have other options, a traditional IRA is $6,000 with a $1,000 catch up, and it just depends on how much you want to save. So if you don't need as much money because you've saved in the past, or maybe you're working in older ages, you can max that out, bring your income down, and bring yourself into a lower rate.
Okay, so basically you're avoiding taxes by putting it in savings rather than them seeing it as income, and you're not paying a higher rate on your taxes.
Yeah.
Okay.
And then one thing I want to caution, if you do have a 401k and you make a pretty good amount, so for example, if you're a husband and your wife has a 401k, and you make 140-ish thousand per year as a couple, you may not be eligible for a traditional IRA deduction. So just watch out for those caveats. You have to talk to a CPA about specific numbers on that.
Okay. Okay.
Another one in the middle, and this is one that I specifically did, is a simple IRA, and that's right in the middle at $13,500 with a $3,000 catch up.
Okay.
If you are making really good money, then you can get into the defined benefit plans, the SEP IRAs, and those kind of things. Those are just higher amounts. They're not as common, but they're more if you have your own business.
Okay. Okay. So save some money so you don't pay as much taxes.
Yeah.
Okay.
There are 2 education credits now. So if you get kids going to college, the biggest one is the American Opportunity Credit. And if you are a true student in your first 4 years, that's the best credit.
Okay.
One thing that I see that people make a mistake on is the kids that are seniors taking 1 or 2 classes in college, only paying $500 to $1,000 of tuition. If they use that 1 year early, then they lose it later because you only get 4 years of that.
Got it.
So that's a big credit. It could be $2,500 if all the numbers work out right.
Okay.
And then the other one is lifetime, where it's 20%. And that one, it can work it as many years as you want. So if you're in your 40s and you want to go take 2 classes in college, make sure you go plug that in and see if you qualify for the credit. And you get 20% back.
So essentially, if you have kids going to college, or if you're going to college, you need to make sure you tell your CPA so you can get those credits. It's not something that happens automatically, right?
Correct.
You have to tell them. Okay.
And the other thing I see is, well, what do you do if you have a 20-year-old student who works and you have parents who make lots of money? Now you have to say, let's bring the kids' return and the parents' return, and let's find the best situation, because sometimes the kids claiming themselves and claiming the education credit is better, and then sometimes if the kids do that, they really mess up the parents' return because they lose maybe $3,000.
Got it.
So make sure that I see this all the time, where the kids and the parents need to bring them together in those young adult ages.
Okay.
This one is a simple one, but charitable deductions, you have your standard deduction, which is actually really high, hard to meet for most families now. On top of that, for the foreseeable future, you can do a charity, and it has to be cash, check, or credit card, not items to Goodwill.
Okay.
But those charities, you can do 600 for a married couple, 300 for a single couple, and that's in addition to a standard deduction. It's not a lot, but if you put it together, you have a 22% rate. That's $100 to $150.
Okay.
Another thing, if you are in Arizona, they have charity credits that specifically become a dollar for dollar for Arizona. So those can work out. You got to make sure that you do the tax correctly, the return correctly, but you can actually give money to your favorite charity, get all of it back on Arizona, and get a federal tax savings. So it's actually earning money.
Okay. So that's like the dollar for dollar one is ones when like kids from schools come to you and say, hey, you get this back dollar for dollar. And isn't it like $400 or?
So there's $400 for a public school, and I'm going to talk married rates right now.
Okay.
Singles in half.
Okay.
Cut it in half for them. But $400 for public school. Private school, you can actually go up to somewhere around $2,500 right now.
Oh, wow.
Your typical charities, as long as they're on the Arizona list, are $800 a married couple, and then there's a list of foster care agencies that are $1,000. And my favorite ones are the foster care, because I feel like the money's going to a really good cause in those ones.
I agree. Okay, so talk to your CPA, find out where you can donate.
Yeah,
because you're going to donate to a good cause, and you're probably going to save on taxes.
Yeah, okay. Absolutely. It's kind of a no-brainer, because if you do it, you're either going to get a savings on the Arizona return, as far as like you're going to get more refund, or you're going to, if you have to pay, you just offset it.
Okay.
So instead of the big government at Arizona getting the money,
yep,
you say this charity gets the money, not the big government.
I love that.
So
I'd always rather give my money to smaller charities. People actually need it instead of the big bad government.
Okay. An HSA, if you have those options, you can even contribute now until the end of the normal tax season, which is April 15th most of the time.
Okay.
So for those, if you're a single person, an HSA is a health savings account. That's $3,600, $7,200 as a family, and if you are in the older ages, catch up is $1,000.
Okay. And when you say you can contribute now until April 15th, that's contributing going back to 2021.
Correct. Tax savings back then.
Okay.
Similar to what people think about with traditional IRAs.
Okay.
So it's a good program, and honestly, if you think about all the hoops to get a medical deduction, if it's inside the itemized deductions, not too much of a deduction. Okay. But if you do it through the HSA, there's definitely more of a savings, so it's a better route.
Okay.
If that's an option. Not everybody has health savings accounts, but if you do, fund that, pay your medical expenses with that, and get a better deduction on taxes.
Okay, it's a good one.
One thing I'm going to mention, especially in the 2021 year, is the earned income credit. They have changed the rules, and it is just phenomenal for 2021. They basically have doubled and tripled the earned income credit amounts. In addition to that, they've raised the income limits on a lot of spots, and they've also removed many of the age restrictions. And here's how I'll say it. In the past, you had to be 25 to 65 years old.
Okay.
And now, if you're not a student, you can be 19, and there's also no age limit at the top. So let me give you an example of maybe someone this will affect. So if you're 67 years old and you have a small job, but you're also living on retirement, you can go get the earned income credit when you weren't available to do it in the past. So, and it used to be $500 for those without kids. Now it's $1,500, and so it's
tripled.
Yeah, it's tripled on the people with no kids, and all those numbers you're going to have to talk to a CPA or research about. But specifically, look for that credit. And another thing you could do is we could tie some of these things together. So let's say, for example, you're above the income limit. Well, go give to your traditional IRA, go give to your HSA, get your money down, And
Okay.
then your income comes down, gets you into earned income credits, and gives you availability to get this really good
To
credit.
get below that. Okay, that's great. So these types of credits, again, is that something you have to ask for, talk to your CPA about, or are they automatically on there? How does that work?
Well, if you are using a TurboTax or a tax software, when you get into those ranges, they should populate.
Okay.
But you know, let's say that, for example, you make 60,000 as a married couple with 3 kids. You're just barely above it. Okay, well, let's go fund our traditional IRA. Let's put 12,000 into it. That puts us at 48,000. Now you
Yeah.
qualify.
Got it.
And that earned income credit for a married couple with 3 kids, it's going to be really big.
Okay.
And you can look up those numbers. They vary between if you're married or single, if you have kids. There's a lot of different numbers. So
Okay.
that's one thing I don't want to bore with the numbers, but
But that's why, to me, it makes sense to use a CPA, because like a TurboTax or some online writer isn't going to tell you, hey, you're just over the limit. Go
Yeah.
contribute here and here and here and get your income down.
yeah.
Whereas a CPA would be able to advise you.
Yeah, and there's times where I get into a situation like that where I say, if you contribute to an IRA, sometimes it's going to be dollar for dollar. Where most situations it's a tax savings, you know, the 25%ish.
Right.
But sometimes when you get these credits, it can be 35, 40%, 50% savings. So
Wow.
it's just huge.
Okay.
So look for that. Another thing with those married families or single, the people with kids. So this is another tax tip, probably my last one I'll give.
Okay.
The dependent care credit is very large this year. So if you have 2 working parents, or if you're you know, a single parent and you have to work, and you have the availability of childcare, it's called the dependent care credit.
Okay.
It used to be at maximum 600 per child. This year it's 4,000 per child, and you get a max of 2. So it can be as high as $8,000.
Wow.
And it's fully refundable. Where in the past it wasn't refundable. So
Okay.
so just giant savings there. And it used to be 20% of your costs. So for example, if you paid $3,000 to your childcare facility, you get 600. Now it's 50%. So if you paid them $8,000 for one child, and that's the max, then you get a 4,000 credit and fully refundable.
Awesome.
So
And again, I know I keep asking this, is that something you have to tell your CPA about, or does it automatically happen?
yeah, you're gonna have to populate that credit.
Okay.
Another tip in that same area is, if your work will help fund those things, that's always the best route, because it's
Okay.
gonna lower your income in the first place.
Okay.
If you are paying daycare, and honestly, in my opinion, if you are doing some of those kind of long-term camps in the summer, those also qualify.
Oh, okay.
So
Okay.
I've seen people do that, where, you know, let's say they're 2 working parents, we get to summer and they put them in an all-day camp during
Yep.
the summer. If you can get the facility's name, address, and ID number, then you have an option to get that credit.
Okay.
So
That's a good tip.
one last little thing is, the child tax credit is huge this year. For 2021, if you do have those, make sure you're paying attention. There's going to be an IRS letter during the month of January that's going to come out. You have to have the letter. If you don't have the letter, good luck. It's
Okay.
It's called it's IRS letter 6419. So I'll give that IRS letter.
Okay.
But get that letter. Make sure that you put the right amount in. If you don't have the correct prepayments on your child tax credit, your refund could be delayed months. And
Wow.
so you want
Okay.
to make sure that you get that.
So
right.
you want to get that letter and either have it when you're online filing your taxes, or give it to your CPA.
Yeah.
Okay.
I would say, honestly, that letter is the most important document you're going to receive this year if you have children.
Okay.
Because you can go to your work and get your W-2. You can ask your retirement company for your retirement distribution. But if you don't have that letter, the route is go to the IRS website and figure it out through them.
And good luck with that.
So yeah, it's
So look in the mail, and what's the number again?
6419.
6419, and we'll link that down below so you know as well.
Yeah.
Okay.
So yeah, that's those are some tax saving tips. If you need anything, just look us up, Mesquite Tax. We're in Mesa on the east side. So
Okay. And I'll link Mesquite Tax, all the information down below as well, your website, phone number, all of that stuff.
all right.
So thank you, Tyler. Appreciate it. Guys, thanks for watching, and we'll see you in the next video.
Okay.